Let's welcome in R. Sreesankar of Prabhudas Lilladher. He's now joining us live. Sri, what is the sense that you get in terms of market? The recent up move, the ongoing buying that DIIs are doing. Do you think valuations are now getting into a zone where incremental buying, has to be done with extreme caution?
I think, Pankaj, let's not forget that markets have been on a roll, and it's not only the Indian markets which have been on a roll, but the global markets have continued to be on an upward momentum. So India has also participated in it. The beauty this time is, normally whenever we see the markets go up, there is a huge amount of participation that comes from the overseas investors or FII investors. This time around, in the last 4 months, if you see, there has been a large FII outflow. Despite that, the markets have been showing resilience and strength because of the inflow that we have seen with the domestic mutual funds, and that continues to remain strong. The other point is, normally at the last quarter of the year, the fourth quarter of the year, you see a lot of domestic insurance companies also getting larger inflows, and that it tends to be a bit more stronger. And I don't think that, given the current environment, you will continue to see, even in the month of March, my expectation is that you should see stronger inflows from the DIIs, and should that continue to happen, the markets will tend to remain high because the global markets are also supporting that kind of environment. So all in all, while the PE, to me, when an optimistic scenario happens, the market price earning multiples tend to expand. What we have actually seen is the market price earning multiples expand rather than earnings actually go up quite a lot. So I think if I look at a 10-year average of the entire market has traded at the average of 18.5x or something like that, or 12-month forward earnings. Assuming that earnings growth what we have for next year, which is a 22% growth over the current year, roughly 22%, is still intact, you are actually seeing the market at around 17.9x 12-month forward, which probably, in my view, gives a upside of another 200 points, 300 points, etc. in the near term, 300 points. Probably that much is around about that, give or take a few percentage here or there. That's the kind of an upside that is there. So the valuation obviously is not cheap. So there's a lot of need to exercise caution at that side. And that's probably the reason you have seen also a lot of mutual funds coming out and giving, probably stopping investments into closing their funds so that new inflow doesn't come into some of the mid-cap funds. That's also explaining the valuations are not cheap.
Right. So you think market returns will now be equal to what sort of earnings growth you see?
Very difficult to pinpoint on that numbers. What will happen is that if the flow continues to be there, you tend to see the market PEs expand. So there could be a point wherein you probably will not see much of a return happen in the near term. But over a period of time, over a longer term, it will all cancel each other, or rather get nullified. Because we are looking from a point to point. So my view, it's not it's not cheap at all. And to look at how much of return that you are going to get in the next 1 year or next 6 months, very difficult to predict. But I would think that it's not going to be significantly higher.
Right. In terms of earnings growth and what market is predicting, do you think 3-4 years of base effect and now a double-digit, slightly higher than double-digit growth is achievable?
Double-digit growth in what?
In Nifty or Sensex EPS?
I think we are expecting a double-digit growth in Nifty earnings. Even for the current year, Nifty earnings estimated is around 419. You compare it with last year, which was at around 357 or so. So that's also a 17% growth. It's a double-digit growth. And estimate is that for next year, Nifty earnings are at around 510.6, which probably is at a 21.6% growth from FY17 estimates. Now the big question here is, how much is going to be the FY17 estimates getting revised downwards once you are doing a pre-quarterly earnings estimate for all these companies, etc., all these banks. And we have to bear in mind a couple of factors out here. The significant, the sector which has got a 32.2% weight in the Nifty is banks and financials. And then you have autos at around 11.5. In our estimate, these two sectors have got over 30% earnings growth for FY18. So significantly, earnings growth is going to get driven by automobiles and banking. Metals may see an earnings growth, but metals constitute only 3% of the Nifty weight. So it doesn't significantly alter my earnings estimate for the whole Nifty per se. So if you see banks moving this side or that side, then there is going to be an issue. That's number one. Number two, even within banks, the pre-provisioning operating profit for the 9 months have grown by 19%. But the net profits has not grown because significant addition to provisions. Provisions other than tax is up 75% because of the bad assets. So if the aging of the assets happen, you at one side you have an operating profit growth, which is pre-provisioning operating profit, but all the profit growth will get mired in something like provisioning. So that is going to be crucial. If you are going to see some solutions, some resolution happening out there, then the provisioning, if it comes down, you will see a significant earnings growth happening at the bank side. If banks actually start to soar significantly, then the earnings growth for the Nifty also will change quite dramatically. That's the only caveat that I need to say now.
Right. So, in terms of corporate banks, do you believe that one should go overweight on corporate banks because markets is not factoring in any major recovery?
See, in our topics, we continue to have banks. What are the banks that we like? We like HDFC Bank, we like State Bank of India, we like Kotak Mahindra, we like IndusInd Bank. And these are all the 4 banks which we continue to have in our topics. And we continue to stick with that in the topics at those banks. We also like, so when you look at the other banks, whether it is Federal, whether it is Yes Bank, etc., a lot of these banks also continue to be in the category, whether it is among the PSUs. Some of these banks like Bank of India, PNB, Bank of Baroda, a lot of them had huge addition to NPAs and that huge provisioning also done. But somebody like Bank of Baroda who has done a lot of provisioning, and if you don't see significant addition to incremental addition to NPA, because the PCR is already pretty high, the highest in the PSU banking space, etc., there is probably our way of thinking will be much more inclined towards a Bank of Baroda like story. Though at the current price, it looks fairly priced. But once you don't see significant addition, then it's wrong. But when you say corporate banks, if you look at again the slippages among the private banks, Axis and ICICI still continue to see a larger slippages. So, which is not the case with many of the other public sector banks or even the private sector banks that I mentioned. So, there is an element of differentiation and valuation which comes in. Now, it's a second issue that there has been a lot of buzz around in the marketplace around certain mergers or acquisitions or whatever kind of things happening in the banking space. So that has driven some of the banking stocks onto the higher level. That can't be taken as a base, as a certainty for estimating the kind of best picks in this kind of a segment. If even in my estimate, if somebody has to acquire or some acquisition happens, or even Suti stake sale in even in Axis, etc., happen, the kind of money that needs to be sunk is quite huge. Who's got that kind of a money right now to look at it, unless a stock swap happens or to that extent, etc. So, to my mind, valuations based on or the stock price movements recently, based on these the rumors or the expected takeover or a merger, etc. That's something which I'm leaving it on the side. I'm purely speaking from fundamental view of looking at these banks, and these are the 4 best picks that we have in the sector.
All right, Sreesankar, what are the other stocks or sectors that you like and you're bullish on? From here on, which ones do you think can outperform?
See, we still continue to believe that diagnostic is a sector which will continue to do well. Hospitals and healthcare and diagnostics. When I say healthcare, I'm not talking about the generic companies or the formulation companies to that extent, but on the hospital side and the diagnostic side. We continue to believe that thyrocare is a classic long-term growth story. That segment will continue to see a lot of free cash generation. Capex will be relatively lower. So we still continue to like it. And we also believe that that segment also, because the valuations of these companies, whether it is thyrocare or whether it is Dr. Lal Pathlabs, etc., which has gone up. And you'll see a lot more private equity getting into regional players. So there is going to be more competition coming in. If competition comes in, it is always good for the consumer because the prices of many of these tests and everything and actually will start to drop. Thyrocare has already is one of the lowest cost at these segments, which is extremely positive for the public at large. And in general, it's going to be much beneficial. So but we continue to see tremendous growth opportunities there. We like it.
All right. Now, if you're bullish on the diagnostic space, would you then also have a positive view on some of these smaller fitness companies that are listed, given the awareness about health and well-being and how that is improving? Would you look at some of these kind of companies positively?
Which kind of companies?
Fitness companies.
Hello?
Shri, I'm talking about fitness and gym companies like Talwarkar is listed. Would you hold a positive view if you think wellness and health is going to be a priority for Indians?
I think I will dealing diagnostics completely from gym or any of those companies, etc. Now, why we like some of these companies effectively from diagnostic? Now, I mentioned about the free cash generation that many of these companies are making and the kind of a capex that it needs to generate. And if any of these companies, when you speak about it, most of these companies, when in the diagnostic space, you have pan-India players, whether it is SRL, whether it is, SRL, which is a part of Fortis, then you have Thyrocare or even Dr. Lal Pathlabs, which is probably the three listed entities which I can name straight away. And the skew of regional players, which are regional in nature. Now, to get a scale for a lot of those, gym companies, etc., it takes time. Some of these companies are already listed. You have the financials of it out there in the marketplace. So, to me, to have that great comfortability, it may take a little more time. I'm not looked much deeper into that right at this stage, but my thought process, once you start generating a lot more free cash, that's probably the time when the market is going to give a bigger thumbs up for a lot of these companies.
Right. Shri, what about some of the retail companies? We've seen them move up higher in the recent past, in the recent few sessions. Some of the valuations there are not looking very comfortable. They look stretched, given that post demonetization there was an impact in some of the retail companies. How would you view the retail space now?
What do you mean by retail space out here? Are you looking at companies like Future, General, or Trent, or
Shoppers Stop?
Any one of this?
Yes.
Or Shoppers Stop?
Yes, these companies.
Okay. So, to my mind, the space is quite interesting, and the opportunity is there for everybody to grow. And the online space is even more giving competition. But what will be more interesting is to watch the should I say a new kid on the block which is coming with an IPO, which is Avenue Supermarkets. So once they come out with an idea, the numbers are there for everybody to see. It's like a sea change from what you have seen for the numbers for a lot of other companies. So I think from the segment itself will start getting a re-rating, a great re-rating upwards. But what's more important is then people are going to look much deeper into these companies and why somebody has got a superior ROC, like return on invested capital and the kind of returns that they have, and why somebody doesn't have, somebody still bleeds or somebody doesn't have much of a thing. what is the revenue per square feet of a place that you have, etc. Then the valuations came into place and comparison starts into place. That's when the differentiation will tend to happen. Right now it's a party time, so everything has moved up. But I think I think soon when these data points are available and when people start to look at it much more deeper, you will see the differentiation.
All right, Sri. Thank you so much for speaking with us at NDTV Profit, giving us your views on all the stocks and sectors that you like.